Hey, what's up? Thanks for tuning in. I mainly talk about day trading, but today I want to talk about something really important that I think everybody should have, whether you're a day trader, a swing trader, a position trader, or whatever. And that is going to be having a portfolio for long-term goals. Throughout the video, I'm going to explain why I have my portfolio set up the way it is. And at the end of the video, I'm going to show you my actual holdings. So this is something everyone needs no matter what your style is when it comes to investing or trading. Something that you can safely add money to every time you get a paycheck, or if some extra money comes along, such as a gift or a tax return, or maybe if you sold something. Basically, any money that is a little extra that you can afford to put into a long-term portfolio. Because the portfolio that I'm going to be showing you is a lazy man's set it and forget it style portfolio that is almost guaranteed to grow over time. And I say the word almost because there could be a chance the world could end and we all die. I don't think that's going to happen, but no one can predict the future. So the reason we should have a portfolio like this is because it's the best and least riskiest way to secure our future. Now, we live in a day and age now where everyone thinks about the now. Whenever they get extra money from their paycheck, they think automatically, yay, I got extra money. How can I spend it? I'll go buy a new outfit, or I'll go to fancy restaurants, or I'll buy a new video game. And they keep repeating that same process, spending their extra money on things that they don't really even need. And by doing that, they're not securing their future. They never think about it. They're always in the now. And most people don't realize it, but it doesn't take a lot of money to invest in your future, especially if you have a long time horizon, which is why I made this video specifically for the younger age group. So let me show you some examples of the kind of numbers that we're talking about. All right, so here I have my handy dandy compound interest calculator, and I'm just going to use this to kind of generate some numbers here. So let's say that you're 18 years old. You just became legal age and you want to get into the stock market, and you maybe have $1,000. So $1,000, that's pretty good for an 18-year-old to save up $1,000. And let's say you plan on every single month for the rest of your life, you can afford to put in $100 into your portfolio. Now, $100, that sounds like a lot to some people, but think about it. Just don't go out to eat 2 times out of the month. I mean, a lot of dinners and stuff cost $30, $50 or whatever, especially if you're paying for, a girlfriend or boyfriend or something. $100, pretty easy. Don't buy that one video game. You can do it if you put your mind to it. Now, the portfolio that we're going to be designing is something that tracks the overall market. And over the last 100 years, the overall market usually gains anywhere between 8 to 12%. So we're going to go a little conservative here, and we're going to say we're going to get an 8% annual gain. Now, we're going to compound our gains monthly because every single month we're going to be adding to our portfolio. And since we're 18 years old at this time, let's say that the long-term goal for this is to cash out once we get near retirement. Maybe we want to retire early, I don't know, but let's just say at 60 years old, we're looking to cash out of our profits. So 18 years old, going to cash out 60 years old, that's 42 years. So we're going to just keep adding $100 every month for 42 years. And we're going to compound our gains, and we're going to also get the gains of what the market gives us. When we are 60 years old, this is going to be our account balance, $443,000. So close to $500,000. And look at the total deposits. We only deposited $51,000 throughout the lifetime of this account, but it grew. I mean, it exponentially grew. So the market really gave us, almost close to $400,000. So that's a really good nest egg to have once you are up in your 60s, long-term horizon. Now you can take this a step further. For an 18-year-old, $100 a month, that may be hard, but once you get your career or whatever and you start getting some bigger paychecks, you can always increase this. So let's say you increase it to, I don't know, $500. You increase that to $500, and we'll do it for let's do it for 30 years or something. Calculate that, and we're getting close to $750,000. Okay, so you can see how this can really add up, especially if you have a long time horizon. Let's say that you did pretty well once you're 18. You just straight out of high school, you got a really good job, and you do this for 42 years. And you're gonna put in $500 a month, and you're just starting out with $1,000. Compound that, you're gonna have $2.1 million by the time you're 60 years old. So you can see, I mean, you can go to any compound interest website, just Google compound interest calculator, and just kind of play around with the numbers that you think you might be able to work with. And your future value is going to be really big. And that's really going to help you out later down the road for if you want to retire, or maybe this account isn't just for retirement. Maybe you just want to save for a house in 10 years. So 10 years down the road, compound interest that, you're going to be paying in $61,000, but 10 years down the road, you could be getting $94,000. So you got that extra 30 grand just by, setting a long-term goal. So this is really going to help out later on down the road. Now, a lot of people start off picking and choosing individual stocks, but it's actually much harder than you think to actually profit long-term that way. In fact, 90% of professional active fund managers who try to pick and choose stocks can't even outperform the overall market over a long time period. And these are professionals, people that have finance degrees, people that have lots of experience in this subject, people whose sole job it is to make money for whatever investing company that they're working for. So if they can't beat the market over a long period of time, it's highly unlikely that you, which I'm assuming is the average Joe, is going to do any better. And the reason single stock picking is so difficult is because of a few things. Number one, you're putting all your eggs in one basket. Even if you only pick what you think are the best companies that you believe aren't going anywhere, such as, well, my favorites are Visa, Amazon, Microsoft, NVIDIA. I can name a ton of others, but you get the picture. Big, good, strong companies. Even if you only pick the best, there's no guarantee that those companies will keep outperforming year after year after year, or even be around 10 years down the road. Lots of things can take place that could possibly take down those giants. You have new innovations that could come out to outdate them. New competition could arise. You could have poor management to decrease sales. I mean, lots of things could happen, and there's really no way to foresee that. So while the possibility of something like that happening to one of those big companies in the short term is really slim, it's really impossible to know how these companies are going to perform 10, 20, 30 years from now. So just to give you some examples of what I'm talking about here, let's take Blockbuster as an example. Do you remember Blockbuster, the big popular video rental store of the 90s? I mean, it seemed like there was a Blockbuster on every corner where I grew up, and that place was packed every single weekend. And to an investor during that time period, it may seem like a great stock to invest in. They may say, wow, this place is making money, it's popular, it's packed every weekend, they aren't going anywhere. But then you had the rise of faster internet. You had the rise of new companies such as Netflix, or you had companies with new ideas such as Redbox. And they came along, and these new innovative ideas and technologies ended up taking Blockbuster out of business. Another one I can think of is Lehman Brothers. They were the fourth largest investment bank in America. I mean, a company that big, shoot, They ain't going anywhere. But then the crash of 2008 happened and take their stock price from an all-time high of $86 all the way down to zero in just 1 year. And while its stock was declining, you had people say, buy the dip, buy the dip. It's Lehman Brothers. They're a good big company. And people did. They bought the dip. And they averaged down. They kept averaging down, saying, it's Lehman Brothers. It's good. And they averaged down all the way to zero. And that right there is all it takes to just ruin your savings. It just takes one of your holdings to take a dive and just never come back up again. So to eliminate that risk of that happening to us, we need to diversify. Diversification is a strategy that mixes a wide variety of assets together so that the positive performance of some assets will kind of neutralize the negative performance of others. And by doing this, we're going to be eliminating the risk of holding a company that will ruin your portfolio if it goes through a rough patch. Diversifying is the best way to achieve the highest returns while also having the least amount of risk. But the problem with diversification is you need a very large basket of assets to do it properly. If you are trying to achieve proper diversification with single stocks, then you would need between 50 and 100 stocks to do it right. And that could be really difficult if you have a small account balance. But let's say that you do have a really large account. You have hundreds of thousands of dollars. You would have to spend a lot of time and focus on each one of your holdings to make sure that they aren't having business problems. You'll need to keep up to date with the news. You need to keep up to date with its performance. You need to look into financial records, all that stuff, so that you don't end up holding a Blockbuster or a Lehman Brothers once they start to have problems. But the problem is that keeping up with the news and the performance is not only a ton of work, but it can also influence a lot of emotional decisions. And decisions based off emotion is not good for investing. You can have a bad earnings report that could come out for one of your holdings, and you may say, okay, it's time to sell. Or maybe it had a really strong run and you don't want to lose any of your profits, so you say, let's sell. Here's the top, let's sell. Or maybe it had a big sell-off because of some bad news article that you didn't want to lose any more money, so you just sell. All those decisions to sell were based off emotions because of short-term events. And those short-term events don't necessarily mean that your stock is going to decline from there on out. Remember, this is long-term investing. And by picking single stocks, it's easier to kind of lose sight of that long-term goal and let short-term events influence your decisions. So instead of investing in single stocks, I choose to invest in ETFs. An ETF stands for Exchange Traded Fund, which is a basket of diversified securities that can be bought or sold through a broker just like a single stock could. They have their own ticker symbol, they have their own share price, they pay dividends, but an ETF is like buying a mini portfolio. It could have 10 to 100 different stocks inside that portfolio. So you can see the difference between the risk involved between a single stock and a diversified ETF. If you invested most of your portfolio in Facebook and Facebook started having problems, then your account could take a major hit. But if you invested in an ETF which holds Facebook and Facebook took a hit, then the other stocks inside the ETF could perform well enough to offset the loss from Facebook. So what you're doing is reducing that exposure to the risk of a failing company. And lots of times, these mini portfolios are actually cheaper than some of the higher priced stocks which are included inside the portfolio. So Facebook at the time of this recording is trading around $180 per share. But one of my favorite ETFs called SCHG actually has Facebook inside this portfolio, and it is only $80 per share. And it also has exposure to companies like Amazon, Apple, Berkshire Hathaway, and other really good companies, but those companies are priced at hundreds of dollars per share. So for someone that wants exposure to all these companies but doesn't have the account balance to purchase all those companies individually, then the ETF is the way to go. There are thousands of ETFs to choose from, and they can be all separated by different schemes. You can choose ETFs that track a major index, such as the S&P 500, NASDAQ, or the Dow Jones. You can choose ETFs that focus on bonds. You can choose ETFs that track a certain sector, such as technology, financials, or healthcare. You can choose ETFs that focus on market capitalization, such as large caps or small caps. They have international ETFs, which gives you exposure to the best companies around the world. And they also have actively managed ETFs, where these are run by professional fund managers picking and choosing stocks inside the portfolio to try to beat the market. Now, remember, these are actively managed, so there's a little bit more risk, but some years they do pretty well. You can get really granular with designing your portfolio with ETFs, but it all depends on what your goals are, your time horizon, and what your risk tolerance is. Now, I personally have my long-term portfolio designed around market capitalization, allocating amongst large caps, mid caps, small caps, and international. I also have some real estate in there to take advantage of some high dividends along with appreciation of that. And within each one of these asset classes, I diversify even further by dividing them up into different styles such as growth, value, and fundamental. When ETFs are created using the style approach, it groups stocks into certain categories. Fundamental stocks are those that meet the criteria of having very strong financial statements. They have good debt levels, they have good price to earning ratios, they have increasing sales. Basically, everything about the business is very stable and is projected to continue to be stable for a long period. Normally, these companies don't see explosive returns, but they do provide attractive dividends. Growth stocks are expected to grow at a rate significantly above the average market rate. And usually these companies do not pay dividends. Think of Amazon, Facebook, or Google. These companies have made over 100% moves over the past 5 years because they are growing companies that are constantly innovating and generating profits. Value stocks are like fundamental stocks, but are priced very well for the current market conditions. So basically, it's getting a fundamental stock at a discount based on short-term market swings. And the reason I divide it up in these three styles is that market conditions and the economy constantly change, which sometimes favor the fundamentals and sometimes favor the growth stocks. So by allocating across these different styles, I can truly leave this portfolio on autopilot, not having to guess when the market is good for fundamentals or when the market is good for growth. I'm simply diversifying for the changing conditions of the market. So this is my long-term set it and forget it portfolio, and I really want to stress here that it is designed specifically for me. This may not work for you. I'm just showing you this to give you an idea of how to put a portfolio together. Your portfolio should be designed around your age, your goals, and your financial situation. For me, I am 29 years old. The goal for this portfolio is to grow it as much as possible until I am 60 years old. I have no debt. I have an emergency fund. I have plenty of income to where I can safely contribute to this every month, and there will hopefully never be a situation to where I have to touch this. So I designed this portfolio to be as aggressive as possible, which is why it's 94% equities. You may have heard the term asset allocation. It's suggested that people my age have an 80-20 allocation, meaning 80% equities and 20% bonds in their portfolio. Or for people in their 50s, they may have a 60-40, 60% equities, 40% bonds. So it really depends on your age for what your allocation should be. Now, as I get older, I will be adding bonds to this portfolio because bonds are a safe investment vehicle that doesn't really grow much, but it protects your money in case of market downturns. And as you get older, nearing retirement, you really can't afford to lose your nest egg due to a market downturn, which is why it's wise to slowly increase the amount of bonds as you get older. So as you can see here, it's all ETFs divided up by large, mid, small, and international. And within each of these groups, I have them divided up by fundamental, growth, and value. So by doing this, I'm properly diversified across the board. So I want to kind of dive into a couple of these ETFs to kind of show you. I use Charles Schwab for all my long-term investments, so let's take a look at them. All right, so we're going to look at that first ETF on the list, which was FNDX. FNDX. So this is Schwab's ETF for fundamental large caps. Now, Schwab owns this ETF. They have fund managers that kind of manage this little mini portfolio. And because of that, since it's Schwab's and I'm using a Schwab account, this is commission free. So you see right here, I can trade this as much as I want, commission free. They're not going to charge me at all. So this is pretty much just like trading a stock. It's got its own ticker symbol, FNDX. The last price was $38.99. So if I want to buy 10 shares, I can come over here to trade and then type in my order and buy it. And if I want to turn around and sell it the next day, I can sell it. All commission free because this is Schwab's ETF. So it's got a nice uptrending stock chart. It pretty much just tracks the overall market, tracks a U.S. large company index. So the major indexes, that's what it kind of tracks. And if you pull up, the S&P 500, it's very similar. So that's what it kind of tracks. Now, another important thing to know is ETFs do have another expense. Now, you're not going to be charged commissions whenever you buy and sell the stock. You're not going to be charged that way, but annually you will be charged a expense ratio. So that's down here, 0.25%. Schwab is going to charge you that. And the reason for that is because all their fund managers and all that are kind of managing the holdings. So these are all the holdings that FNDX has within this little mini portfolio. It's got Apple, Exxon, AT&T, Chevron. I mean, all these are really big, nice, well-performing companies. And a lot of them also pay dividends. So it's kind of Schwab's fund manager's duty to make sure that all these dividends go to you. And that's kind of what you're paying for, is for them to kind of manage all those holdings. So you're going to be paying 0.25%. Now, that's a little high. I'll show you the next one. It's actually much cheaper. But also, you see right here, distribution yield, 2.23%. So you're going to get that annually just by holding this ETF. So let's look at another one, SCHG. So this is Schwab's growth large cap companies. So the large cap growth, it's same thing. It's run by Schwab. There's no commissions or anything on this, but this is stocks that are expected to grow. So if we go down here, it's got a lot of big, well-performing companies. It's got Microsoft, Apple, Amazon, Facebook, Google, Verizon. I mean, all these really perform well. Apple up 29% for the year. Facebook up 36% for the year. This just this ETF alone over the past 5 years. Now this is annualized return. So over the past 5 years, it's averaged out 12.8% per year. So this is the growth ETF, and look at the expense ratio, only 0.04. So this is very little. It's very tiny. That's kind of what you want to look for when you pick out your ETFs. Make sure that the expense ratio isn't high. There are some ETFs out there, especially the actively managed ones. They can charge 1% or 2%, which is a lot. But this is one of my favorite ETFs just because it has all these really outstanding companies, and you can kind of see the percentage of this ETF that each one of these stocks are part of. So Microsoft, their biggest holding, 6.3%. is Microsoft within this little portfolio ETF. So these are the growth stocks, and they also pay dividends. So this one pays 1.11% of dividends. It's not high, but that's not really what growth stocks do. They don't really perform in the sense of dividends. They perform in its stock price really going up. So that's SCHG. We'll take a look at SCHV, which is the value stocks. So this is large cap value. Their dividends 2.84%, expense ratio of 0.04%, and their holdings are a little bit different. So they got Johnson & Johnson, JP Morgan, Bank of America, Intel, all very big companies, but they're very stable. Okay, so they're not going anywhere, but these companies don't really outperform. Just like Amazon. Amazon went up like 100% in 5 years, but Johnson & Johnson, I mean, they're stable, but they don't really just skyrocket. They pay good dividends. So this one's just kind of stable, as you see over the past 5 years. It's kind of had this average return of 8.69%, which is the average market percentage gain. So they pay 2.4 or 2.84% of dividends. So play around with it. Go to your broker, whatever one, and just kind of look and just see what the holdings are, which ones you like. You can separate these all kinds. Let's go to the screener here just to kind of show you what you can search for. I mean, here's all your large cap value, mid cap growth, small cap growth. They also have blends, which I have a couple of those, which kind of blend value and growth together. Let's see, screener. So you can kind of search by the portfolio, weighting scheme. So you can choose, ETFs that have good earnings, the dividends, the fundamentals, the liquidity, the market cap. You can do momentum stocks. You can, by the revenue. I mean, they also have technical ETFs that are just in there strictly for technicals. They have fund managers that are really good technical traders. They say, okay, well, I'm going to put this in their portfolio because the technicals are good and all that stuff. So like I said, you can get really granular with this stuff. All right, so I have my portfolio set up this way because when markets experience downturns, usually the fundamental stocks outperform. And when markets are doing really well, usually the growth stocks outperform. So no matter what, my portfolio will kind of always balance itself out. Now, this doesn't mean that my portfolio will never take a large hit, such as losing 20% or 40% in value, because it definitely can and it definitely will when we run into a big bear market. And this is what is really important here. You have to be mindful that in the end, if you never touch this portfolio, no matter what, no matter how much value it loses in bad times, it is always going to come back up and rise in value. Why? Number one, it's fully diversified. Every one of these ETFs holds tens or hundreds of different stocks, and it's really highly unlikely, if not impossible, for every single company within these ETFs to go bankrupt. Number two, no matter how bad times get, it's our human nature to rebuild and improve. Ever since the beginning of mankind, we have always improved. And even when times get bad, using examples such as the Great Depression, the World Wars, the Great Recession, we always step up, fix it, and keep striving to improve. And when you diversify in a way like this portfolio, investing in hundreds of companies across the board, that is what you are investing in. You're investing in mankind improving and growing in value, which is something that is almost guaranteed to happen, as it's been happening for the past tens of thousands of years. So if you haven't already, I really hope you take the step to make a portfolio and invest in your future. Hope you learned something. Thanks for watching.